if you can pattern match across verticals, if you can pattern match across the ecosystem, if you're very disciplined in terms of what it is that you fund and why and what you're actually looking for in terms of people and theme, you'd rather be a generalist fund. You're going to make more money as a generalist fund than as a deep specialist.
Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Sam Lessin of Slow Ventures. Slow is an early stage VC fund that invests across fintech, SaaS, crypto, healthcare, and more. And they also have a dedicated fund focused on the creator economy, which is pretty unique. In this wide-ranging episode, we talk about what Slow invests in across its 5 funds, why Slow is a generalist fund, how Sam and Kevin raised Fund 1 from ex-Facebook employees, why Slow decided to launch a dedicated creator fund, and what that fund is investing in, his advice to emerging managers, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup, or FundingStack.com if you're a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a new Get Intro tool that'll help you get warm intros to those investors, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Sam.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Sam Lessin of Slow Ventures. How are you doing?
I'm doing well. Thanks for having me. Happy to be here.
Likewise. Are you guys doing anything for Tech Week, which is going on as we speak?
No, I think the idea of San Francisco Tech Week is ridiculous. Every week is Tech Week in San Francisco. It's like I would be more excited about San Francisco not Tech Week.
Good point. Good point. Yeah. I guess the only interesting part is I've been going to a bunch of events and it does draw in, like people fly in. Everyone I've met is from somewhere else.
That makes sense because if you live in San Francisco, you don't need to go to Tech Week. You are Tech Week all the time. It's like I will say my only commentary is I've had several founders come in for meetings and they're staying in the shittiest hotels because every hotel is like $10,000 a night because of Tech Week. So it's great for the hotel industry. Go hotel industry.
Well, frankly, you want to see that survive. You want to see restaurants.
Totally. I'm into it. Daniel Lurie, the mayor of San Francisco, must love it.
Yeah. Good stuff. All right. Well, let's jump into it. So what is Slow Ventures? What are you guys all about?
I'm not sure. What are we about? We've been doing this like 10 years-ish. There's everyone has a good founding story where you can kind of pick what date is the real founding. But the upshot is we've been doing it pretty professionally since 2014. We've invested 5 funds in our core seed product, plus a few opportunity funds, plus we have a creator fund that we do and a bunch of exploratory stuff. And look, we're hyper generalist early stage seed investors. We try to be first, we try to be right. We try to back amazing people doing important things in important spaces, and we mostly waste money, but every once in a while we don't.
Yeah. What fund thesis? I mean, I know you've got the creator fund, which is kind of its own separate thing, but beyond that, industries, I think you said stages, seed early.
We're very disciplined about the size and strategy of checks we write. We are seed investors. We write $1 to $3 million checks for 10% basically of companies. We don't want to be on the board. We don't want to take 20%. We don't want to take 5%. We have like a pretty tight buy box from that perspective. And we think that there's a really good discipline in terms of what that ends up meaning for what you do and don't invest in. Because it kind of like, in the end of the day, like whatever metrics you pick drives who you are, right? Metrics are destiny. And so that's kind of a core metric we really think about. We think is the right buy box for us. We have an angel program we go earlier. We have an opportunity fund we can be a little more creative with and do things. We have a oops, we missed it bucket, right? For important stuff that we just weren't in. But yeah, that's kind of what we do, and we're very, very, very agnostic on, we're not a deep tech fund. We're not a whatever fund. We've done a ton in crypto. We're not a crypto fund. We go where there's good opportunities to make lots of money and ideally deploy capital that makes a difference.
Mm-hmm. Mm-hmm. But industry, I mean, I'm looking at like your portfolio list, which is scrolls and scrolls and scrolls. It's
Yeah.
pretty much everything, right?
Yeah, I mean, like, look, our view is that we've done a lot in SaaS, we've done stuff in services, we've always done a lot in like crypto and security and all this. Our view is that there's no industry or market that's always good, right? What happens is these things go in cycles. There are seasons for investing in almost anything. And you just got to be really sensitive to what the season is, what the opportunities are, and what's happening. And funds that lock themselves into being like, we're just one thing, you can become like the deep expert in that thing. And there's some value to that sometimes, but it's just too restrained. It's too constrained. You end up putting yourself in this position where there are times when you shouldn't be investing in that. But if you told everyone you're going to invest in that, then you're going to invest in it. And you're either going to lose money or end up with like ridiculous companies, right? And so it's just, our view is that if you can, if you can pattern match across verticals, if you can pattern match across the ecosystem, if you're very disciplined in terms of what it is that you fund and why and what you're actually looking for in terms of people and theme, you'd rather be a generalist fund. You're going to make more money as a generalist fund than as a deep specialist.
When you're pitching that to LPs, though, especially maybe in the early days, like was the pitch, we're going to be a generalist fund, opportunist, and just find there must be some theme or something. We're going to find, great immigrant founders or great Y Combinator alum or something. I mean,
Well, so I think a few things early on, right? Like is different than late. In the end of the day, after you're three funds in, the pitch to LPs is very simple, which is we're either made money or we haven't,
yeah,
and we either still have a way to make
right.
money or we don't, right? It's actually the pitch has become pretty easy, right? And like there are people who get it or who like you're in their buy box in terms of what they're looking to deploy into. There's a strong argument to deploy into seed funds. There's a strong argument not to, right? Like that's more about LP taste than it is about you. You need to know what business you're in. So that's like the late. Early on, look, I mean, I do in the end of the day, the pitches we think we're pretty smart and we have good access. And I think and you kind of go from there. And the question is, how do you demonstrate that you're pretty smart and have pretty good access, right? And I think there's a few ways to do that. I tell young people always, even if you really want to be a venture capitalist or want to be doing early stage funding, you obviously the best case scenario is, you're an executive at some company and you've written some seed checks and they've worked and you've demonstrated you blah, blah, and you have a cool fancy pedigree and blah, fine. But the more important thing is actually to have intellectual receipts on being first and being right. And that's why I'm like a huge fan of people writing. Like people come to me all the time in their early 20s, like, I want to be a VC. They're like, here's my resume. I'm like, I don't care your resume is. Show me what you wrote. What have you written? Like, what insight have you, send me interesting perspectives. Go find things that I didn't find. And even if you can't invest in them, tell me that you knew about it first and were right about it first, right? And the good news for us is I think going in the early funds, we had a bunch of angel checks we had personally written that were super successful. We had been executives at big companies, which in that era, that helped. And we had a ton of writing where we were just like, look, you can just look, we've been right a few times, right? And I think that really helps.
Interesting. Well, let's talk about that. What were you doing before this? What's the genesis story? It's I think three founders or three.
Look, all stories are here's the short version, and sure. There's always don't believe all founding stories because they're all mostly made up. But basically, the story is there's three of us that are GPs: me, Kevin Collar, and Will Quest. Will came on a little bit later, as we were going, and he's kind of our professional venture capitalist, ex-industry ventures guy. Kind of came on initially, kind of focused on our opportunities fund, and now does a lot across the board, including obviously our seed fund. Kevin and I are both Facebook execs. Kevin was like the first ad sales person at Facebook. I was VP of product for many years when there weren't 1,000 of those. There were three of us. And I reported to Mark for years through the IPO, running things like the profiles teams and the privacy teams and things like that. So I left in 2014, but I was there through a pretty interesting formative phase. I had started a company before that. I had invested in a bunch of stuff personally. Slow originally was a collection of effectively angels who just pooled some money. Mostly all Facebook, ex-Facebook people or Facebook people. Dustin Moskovich, Sean Parker, people like that. People had a little liquidity. We were all messing around angel investing. And so there was a slow vehicle, which originally managed by a guy named Dave Morin, who's a very close friend. Yeah. And we basically just pooled up some angel capital and said, look, we're all doing deals on our own. We might as well also do some deals in common, right? And then, that wasn't super professional, right? It was kind of just like a, super angel pocket of money. And then we basically professionalized it. After I had left Facebook, Kevin had been kind of doing an interim job post his Facebook tenure at General Catalyst. We were like, we both like investing. Let's start a real fund and kind of go after it. So that was kind of the story. But it wasn't, it wasn't one of these like straight lines. It was kind of like we were all kind of already doing angel investing and we liked it and we thought there was more to do there and scale. And, our first fund, honestly, I think was too angel plus plus weighted. It wasn't strategic enough. We weren't disciplined enough in certain places. It's fine, but it's not like a fabulous fund. It's kind of like we're in a bunch of cool logos with not enough ownership, right? And then I think like, our third fund, right? Because we called the original one the Rocket Funds, which was really just an angel pocket, right? The first one is technically Slow 2. Slow 3 worked really well. It is working really well. We made a lot of money on it, right? And then we kind of done 4 or 5 and kind of going from there.
What's been the fund size progression there?
I mean, basically, the first real fund was 65, which at that era was a lot. Like the thing that was interesting in that era, because again, it was a long time ago now, is the idea of professional seed/angel investing was very much not a thing, right? Like people were like, you can't make money on that. Like investing is like the Series A and beyond, and everything before that is just friends and family type money. That was kind of the mentality, but the idea of doing it professionally was like, at least not consensus. It went obviously very consensus after that. But we had the benefit of it wasn't like there were 1,000 people doing this. There were some people who liked the idea and some people who didn't like the idea. 65, then I think 145, then like 195. We try to keep the seed funds around 200. I don't know how to make money well on more than $200 million seed funds. I also think it's extremely hard in 2025 to be less than 100 million. So my basic view is like, if you want to do this, you kind of want to be in the 100 to $200 million range in a seed fund. So we kind of just rinse and repeat that model. Maybe we adjust it a little bit for inflation every once in a while, but we're not like, one thing about us that's very different is like, we really don't intellectually have a lot of respect for multi-stage venture capital. It's not that we don't get it. It's like a great business model. AUM is a great business model, right? It's actually a better business model than what we do.
Right.
If you're just looking to get rich. It is. It's like, there's no question that like, it is better to make a ton of money on fees and justify it with DPI than it is to like actually try to make money on DPI, right? For sure. Like it is just a more scalable, better industrial business model. It's just boring from our perspective. And like, we know what we like. And like, what we like is, being right when other people don't see it yet, being first, there's like, it's just like it's a vocation as much as it is like a profession.
That's interesting. Yeah, I don't know if this is true. I saw some speculation that Andreessen Horowitz was making like 700 million a year in fees. It sounds like too much.
It's not that hard to calculate. It's 2% of their AUM, right? Which is just like, now look, the irony is, right, you get into the details of venture, which no one actually understands, or no one outside the industry understands. It's like, you're not making that, right? That's like the payout that you're supposed to pay back with all the DPI, right? And so you're just kind of front loading effectively the cash you get paid, but it is effectively guaranteed, right? There's always some irony to it, right? What you think about venture capitalists are supposed to be risk takers, but it actually, if you're a venture capital partner, it is probably the safest job in the world, right? Like you can't be fired for like 10 years. Your compensation is completely guaranteed, right? It's like, it's as close to as academic tenure as exists outside of the academy, right?
Funny. Never thought of it like that, but yeah. That's interesting.
The other thing to keep in mind with the big firms and AUM is like, it's really simple. Like if you look at how, again, all the big firms are basically, they're businesses. And again, I have no disrespect for them. I just think you got to call it what it is, right? And a lot of them want to go public or are trying to get public. And there's a lot of lessons from PE more broadly and buyout from this. Here's the funny thing. The financial markets do not value returns. They don't care. They're all valued based on effectively your ability to raise capital and the fee structure, right? And so it's just this ironic thing, which is no one cares what's in them. People only care as like a fee stream. So they're obviously optimizing for fee stream because if they're ever going to go public, that's what they're valued based on.
Yeah.
That's what the public market wants, right? And so we have no intentions. I can announce here and now, we have no intentions of ever going public. We're not interested in any of that. But it just means, again, the incentives and metrics are destiny. And so that's why I'm like so obsessed with more than like, oh, we're this type of fund or that. It's like, look, what do we do, right? Like we put this amount of capital in for this amount of ownership. We try to defend it and not lose all of that by the time these companies have liquidity moments. And we don't raise too much money, and we pride ourselves on being first and right and early.
And you mentioned that, you like this sweet spot of 100 to 200 million for a seed fund. Is is 200 kind of the cap just because it's hard to do that many deals with a small partnership or
No, it's not the cap of that. It's because it's hard to make that much money. It's hard, like, if you own 10% of something, right? It goes public for $20 billion, right? Now, the idea that you would make it a $20 billion exit, right, hypothetically, right, without any dilution is fanciful, right? Like, but let's pretend that you could, right? That means that your investment, right, is if you want to 10x on your fund, $200 million fund, you want to return $2 billion in capital, which would be awesome. Like that's like a great fucking fund. You need to own 10% of a $20 billion company, or more realistically, you need to own like you think about it that way. It's like I actually think it's more like $1 billion outcome, right? Because you're gonna get diluted to five realistically. So like it's really a 5x fund at that point. Very rough math. The idea that you're going to generate on $200 million in bets, like, 10, $20 billion in public marks in any reasonable time frame, it's not impossible at all, right? But it's hard, right? And the idea that you can do that repeatedly and well, right, is hard. So the idea you see these seed funds that are $400 million funds, and you're like, wow, to like actually make a lot of money, you have to be in like unbelievable stuff, right? And like it's not that you can't hit it every once in a while, but I don't think you can manufacture it, right? And I think that like at that point it's just gambling, right? And I don't like that, right? I think less than 100, the problem is like you don't have enough shots on goal, right? Like if you're a solo GP running a tiny firm and you can get away with it, you actually, if you get it right, you could do really, really well, but it's really hard and you don't have that many opportunities and you don't have enough money to defend your positions. There's like all these problems with it. So when you kind of like bake out all those variables, it's like I'm pretty confident we can consistently make people serious money if we're like a $200 million fund, but I wouldn't say the same thing if we were a $400 million fund.
makes sense. And what so you're doing all these seed deals, getting 10%. What portion of the fund do you usually reserve for like follow on?
A lot. I mean,
Yeah.
we probably reserve as much money for follow-ons as we put in upfront. And this is one of the things people again, seed investing is really hard, right? Because if you think about it, you can be in something that's a great business but super capital consumptive and you're fucked, right? And so like think about like OpenAI is a great example of this. It's obviously like the company that everyone's like, I wish I had seeded OpenAI. And again, you clearly would make money seeding OpenAI, right? But nowhere near as much money as people think, right? Because if you look at it, I think there's some projections, and again, this is all kind of directional.
Yeah.
Or there are some projections I've seen that reporting that's like the seed investors, because of all the capital that comes in for the compute and the hardware, not to mention paying people several $100 million a year, whatever the comp structure is.
Yeah.
It's so capital intensive that like the seed investors are sitting somewhere like at a 25x, right? And the idea that you make a 25x on that type of investment potentially is like terrible, right? Like I've made 25x on so many things. Like that's actually like, if you think about the way seed works and the mortality rates, like that's just, you need a lot of that. Contrast that to like, probably the best financial deal I've ever done was seeding Solana, right? Where we made almost 2,000 times our money in like 4 years, right? And so like and what's the difference? Like that was like the most capital efficient thing in the history of the world, and OpenAI is like the least capital efficient thing in the history of the world. So the problem is like you have to reserve capital for normal companies and for defending positions, and then you just have to be super sensitive to the fact that like seed investing is a terrible business in businesses that are going to consume a lot of capital, right? Like you need capital efficiency to make it all work.
Yeah, that's an interesting perspective that is kind of obvious when you say it, but you don't always think about it unless you back into the numbers like you just did. That's super interesting. How has your LP makeup changed over these funds? You mentioned the first one was a lot of collection of angels, ex-Facebook folks. Did you guys kind of institutionalize as you?
Yeah, absolutely. I mean, this is like the most boring thing ever, right? But like everyone says this and it's actually true, right? Which is you start out, we had, I think, one sort of institution or semi-institution in the first fund. At this point, I don't know the numbers because my partner Kevin really handles all this, but like my bet is 80% of our capital is like a small number of really high quality institutions. They're far better LPs. They actually respond to capital calls, they pick up the phone, right? They like, they're actually, occasionally helpful strategically, occasionally, right? So like we're very professionalized from that perspective. And I do think it is like, I've heard people try to make counter arguments on this, but I do think it's just one that you don't fight. It's like you'd rather have real institutional capital that's going to be with you for multiple rounds and gets it and will grow with you, etc.
Did you go from the angels into like family offices, or did you kind of go straight to the, pensions and
More the
endowments?
latter, I'd say. More the latter.
Uh-huh.
I mean, again, I think when we talk about individuals, like a lot of people do have family offices, so like there are a lot of family offices, right, that were in the first version of what we were doing, but yeah.
Yeah, interesting. Tell me about this creator fund. This is seems like a little bit of a curveball, or a little different than most. Maybe talk about the idea behind this and
Yeah, well, in some ways, this is a very old idea of ours. I actually wrote one of my essays to try to get into college about kind of the idea. I had bought the domain lifecapital.com, and I was saying to myself, this is when in like the late 90s. I was like, Martha Stewart's gone public. It's like, in the future, I was ahead on the debt part. I was like, debt makes no sense for people, right? For individuals, especially as the world gets more discontinuous in terms of outcomes and inequality. You want an equity structure, right? Which is basically like, yeah, like you already pay the government 50% of what you make every year anyway, right? You'd rather raise capital and say, hey, here's the deal. I need capital to go to school and educate myself and get a kickstart in life. I don't have a rich uncle, right? Like, and so I'm gonna raise the money as equity. If I don't do well or don't do that well, don't worry about it. But if I'm Jeff Bezos, I'm going to pay like a few $1 billion right back into the system, not just like a return the loan. I think that's like a much more sane way to think about personal finance in a lot of ways. And yet it doesn't exist for a whole bunch of reasons. I love this idea. I've pursued it over my career 6 different ways. The creator fund and what we're doing there was like the first way that we have institutional capital behind, where people are like, that actually makes a lot of sense. And it basically comes down to this, which is there's this whole group of people who are effectively community entrepreneurs. They're super deep on a vertical. They love it. They've built a ton of trust with their community because they're the person producing the best content and with the best advice, but it's in a niche or a specific thing that really is their thing. If you're in that position, you have so many advantages, right, to company building. You have nearly free distribution to the right people. You have trust built already. You probably actually have great ideas because you're talking to the right people all the time and you're native to the actual community. And so there's all these reasons you should be great at founding companies. And yet, venture capitalists really won't fund it, really. Like, people are okay funding sometimes what I call like companies started by these types of community leaders, which I actually think is not a good idea to fund them one-off for reasons we can get into. But no one's like, look, I trust you. You're the entrepreneur. It's seed investing for these communities. And so we were like, look, there's a huge amount of money and to be made doing this, providing capital in a place that doesn't otherwise get capital, which, by the way, is the whole point of seed investing. The point of seed investing is you're like, there's no easy way to get capital to build this business because no one trusts you or no one understands it yet. We'll understand you, we'll trust you, and we'll help you build it. So it's exactly synonymous. But it requires an intellectual leap, right, for some people. And it also, really importantly, you talked about LPs, most LPs, their job is to go build like against a theme. They're like, we need 6 things that do this, or 4 things that do this, or we're in this segment of the market, because they're not actually picking individual managers. So the idea of being like, hey, this is like a new category or a style of investing is just much harder to pull off than saying we're yet another thing that looks like the things you already know, right? So we started the fund. It's a $65 million vehicle. We first did a bunch of these deals to prove to ourselves we liked it and we thought it made a lot of sense. It's going really well. Megan Lightcap is running it on the team. And I'm really bullish on it. It's great to be, you think about pricing, it's like, you think about what a $20 million valuation buys you these days. What it buys you in the creator world, unsurprisingly, is dramatically better than what it buys you in AI, right? Like, you can have 2 Stanford kids and an idea, or someone who has is like a really strong business and is like making a bunch of money and has a bunch of awesome ideas on where to take it and is like really much further along. So, there's a bunch of nuances to it, but that's the short version.
What are some examples? I'm looking at a TechCrunch article from a while back about a guy who has a woodworking
Yeah, Jonathan
channel.
Katz-Moses. I love that guy. That guy's awesome. Like, he's probably, there's a few other deals, some of which aren't announced yet, that we're really excited about. But he's actually a great guy to talk about because I think it fits this model almost perfectly, right? Which is JKM, Jonathan Katz-Moses, if you are not into woodworking, you almost certainly have not heard of Jonathan Katz-Moses, right? If you're super into woodworking, you've heard of him, right? You've seen his content. You probably follow him, right? And he's built a set of businesses around being the person who's super trusted in woodworking that are great businesses and working really well, and wanted capital to scale up and go faster, and wanted a partner to do that with. And like, I think it's a win-win-win for everyone, right? From that perspective. So we give him a few $1,000,000. We don't own a piece of one of the businesses. We're like aligned with him. I think alignment with founders is key. If he tomorrow wakes up and says, I want to do XYZ, we're not going to be like, well, you told us you were going to do the other thing, and like, we're investing in other things, so like, don't do it. We're like, absolutely. We want you to do what's best for you, because we're aligned with wherever you're going, right? And like, I think that's kind of the trust mentality and the alignment mentality is like one of the important things we've learned from seed investing is you're backing a person in like a theme, right? If you get too obsessed with the first business model or whatever, you're kind of missing the point.
Wait, what's the profile there? So he's created content, and then did he already have the tools business, or did you guys kind of come in and help him create?
Well, it's not, I mean, look, these things are not so black and white, right? Like the answer is, yeah, he had a tools business, and there's going to be a bigger tools business. Like there's other things he wants to go build. I think for creators, there are creators who just love making content, and like that's all they'll ever do because that's what they want to spend their time on. And that's, I really respect that, but it's not really what we're designed to fund. We're designed to fund people who are entrepreneurs who happen to be community first, right? Which means it's much better if they've demonstrated that they're actually on the path to building businesses, or actually selling things, or they have a commercial intent. Because look, there are other great creators out there who are just in it for the content, and I respect that. You can do just fine doing it, and they're having a lot of fun. It's just not our thing.
Do you have kind of maybe not a hard rule, but even rough benchmarks of, hey, we're looking for creators with X number of followers?
Rough. Yeah, I think it depends on the vertical and the context and things like that. I'd actually say, anyone who has 100,000 to a few million followers, it could make sense for. I mean, there are creators that are just far too big to need venture capital, right? They're like, I don't need this, and that's true.
Did you invest in
Beast
Mr.
is
Beast?
different. I actually, Beast is different. I wouldn't invest in Beast for a different reason, which is like, I don't know. We're really into verticals. Like, we want you to be like, I am the person who's most trusted on X. We're not that obsessed with like how many people watch a video. And the thing about that is like, I think he's so broad in a lot of ways for his appeal that there isn't like, I couldn't tell you, he doesn't own woodworking. He doesn't own aviation, single plane aviation. Like I don't know what you sell, right? And so, the products he sells are CPG products. They're like chocolate or things like that. That's fine. That's what you can sell to everyone. But it's kind of not how we think about the most successful actual creator businesses, even if it becomes a big brand, right?
What are some other categories, some fun examples of creative? Yeah.
Physical therapy, fishing, like I could go down all these like categories of things that we're doing, poker, like there's all sorts of like things. Basically, as the world gets bigger and people kind of see online that like there's infinite variation out there, people are actually getting more and more into smaller and smaller specific niches where it becomes a really important part of their identity and how they spend money and what they do. So you're just seeing like that's the thing about the Creator Fund is like in Silicon Valley, there's a bunch of types of companies where like someone's doing blank. Every firm knows about it. Every person knows about it. And it's just like a pretty efficient market. And like candidly, as a capitalist and like egotistically, I'm not that interested in efficient markets. I want inefficient markets where my capital matters. And like creators is the opposite. It's like full of these niches that are like that you've never heard of that. But when you hear the pitch, you're like, oh my God, that is a shockingly big business with an enormous amount of opportunity. And I think that unless you're actually into it, you will never find, right? And like, that's what's so exciting about it, right? Is it's much bigger and there are so many more versions of it than you'd think.
Yeah. And okay, just to continue on kind of the profile. So have a established following, inefficient market, pretty niche, and then something I'm a little fuzzy about. Do they already have a business going or not?
Sometimes yes, sometimes no.
Okay.
Like I think we want people to like demonstrate to us or give us confidence they're real entrepreneurs, right? And so as opposed to just content creators. how do you demonstrate that? Well, if you started a business already, that's pretty good demonstration that you are in it for the business and are doing it. Like we don't want to be hustled by someone who's like, I'm going to do businesses and they don't do businesses, right? And so that's like a good, but there are plenty of exceptions or changes where you're like, look, this person hasn't started a business yet, but we're very confident that they have entrepreneurial DNA and they're business builders, not just content creators, right? If that makes sense. And I shouldn't say just content creators because that's like, that sounds almost like a value judgment. It's not. It's just like we want people who want to build businesses.
And what do you think the exit model looks like for those types of
It's
businesses?
not different. I mean, that people always ask about this is a very valid question. Like we basically buy in at a top co level, but then we basically own our, pro rata across the businesses they start. Some of those businesses get really big. Some of them get bought. Some of them might be public someday, right? Like the businesses can stand alone. And I think the way we really monetize is through the businesses, but we just want to be fully indexed with the creators as they're making those or doing different things. Because the last thing, in my experience, the number one thing you want as an early stage investor is alignment. You want to be on the same team, right? And with a C corp, that's reasonably easy because you're like came with a business plan, you're vesting equity, you're on the same team. I would say you're on very, very similar teams. It's one thing I always tell entrepreneurs: you're actually not on the same team as your investors. It's a similar team.
You're right.
With creators, the problem is like you commit to one business, you wake up, learn something, and you're like, shit, there's a better business over there. Oh, that's a better business. You don't want to just like keep working on the first version of the business because it happened to be what you sold investors on. And like, so you're stuck doing it. I want to be like, look, do the best by your community you can, full stop, right? If that means you're pivoting, if that means you're starting 4 companies, if that means you're investing, you should do that. Like we want the alignment there. And that's kind of how we think about it. And then ultimately the exits are just companies, right? Like anything else.
Yeah. Yeah. This is maybe a bit loaded and you can skip it if you want, but do you think you'll raise additional creator funds or is this
Yeah,
kind of
absolutely.
one-off experiment? Yeah.
No. I mean, I think it's going really well. We wouldn't, I mean, there's no point in doing a one-off fund for us, right? Like it would
Experimental.
be
Yeah.
like,
See how it goes. But yeah.
it's just we wouldn't have raised the fund if we didn't believe in the theme long term, if that makes sense. Otherwise we would have just done a few opportunity checks and tried it. And what we did is we tried it. We did a few checks out of our opportunity fund to experiment and learn and got a lot of conviction. This is an important thing. We think those deals will do well. We think the creator fund will do great. And candidly, we're just kind of repeating the playbook. Like our first slow ventures fund was $65 million fund, seed fund. This is 65 million. We think that's a good early size to deploy. We'll prove we can deploy it well, and then we'll come back and ask for more money.
Yeah. 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 I think I saw somewhere, maybe it was in the woodworker guy that people apply to this, or is it like a kind of traditional venture
No, it's
model?
like what I'd say is it's a traditional model, but I actually think that in this case the funnel of people applying is great. Like you can apply to it. We do take those applications seriously. He applied to it. That's how we found him, which is amazing. Like usually VCs don't do they take inbound, but not really.
Right.
Like we absolutely got this as an inbound. I think it's really important in something like creator because candidly, like you could have some young associates running around calling every creator in the world. It's not going to be a fit for like 98% of them, right? And so it's incredibly inefficient to do that. What's much more efficient is to market, hey, if you're a creator and you run a community that looks like this and like you have some business ideas and you think capital will accelerate it, give us a call, right? Like inbound is way more powerful than outbound there, which is why I'm so focused on it and why I think the application is useful. Like, because otherwise it's an impossible ecosystem to go outbound on.
Are these and this is a blanket statement, but are these creators business people or do you have to, yeah, I think of creators, maybe I'm stereotyping, not
I
always
think
the
you're
most savvy
stereotyping.
business people.
You're
You know what I
you're
mean?
very stereo. You're really like you're limiting your purview here of how you think. About it.
Totally. I
Look, here's
admit
the way to think about it. Like I analogize this to Silicon Valley, call it in 2005, 2006. You had all these old VCs, right? And they'd be like, "You're great at PHP and you're building websites, but you're not a business person. You're not an entrepreneur, right? Let's find an entrepreneur to work with the tech person." And you're like,
Sure.
if you look at that era, all the most iconic companies, you know what they were built by? People who like this Mark Zuckerberg were programmers who learned business as they needed,
Yeah.
right? And I think it's exactly the same thing, which is like I love that everyone doesn't get this, or a lot of people are snotty about it. Like be as snotty as you possibly can about, oh, these aren't business people. It's like no, they're just great leaders, right? And if they want to build businesses, it's not that hard to learn how to do. You just need to actually care and drive and be good, right?
Yeah. Oh, that's totally fair. It's easier to learn business than it is to learn how to build
Yeah, I mean, the idea
a
that you're not going to
successful
have some
computer.
like business school. I mean, you know what I actually actively dislike is every once in a while you'll find some business school person. Again, I'm not against business school, really. I play it a little bit. Is like, and they were like, I'm going to do a market study and figure out that trout fishing is a great vertical. And now that I will become the god of trout fishing because it's a good business to, and you start from the business, it never works. Like you
Yeah.
need to actually love the thing and be natively awesome at it and excited to win. I think this is my same criticism of a lot of these incubators. I understand the instinct. There's a lot of people who like would love to start a company, but they don't know how, or like they don't quite have the confidence to do it alone, or they're like, there's all sorts of reasons you end up as a person being like, I should do an incubator. And then as a VC, you're like, look, things are too expensive. I want to scale my ability to talk to companies a bunch. Isn't it better to be earlier? Let's just do classes and run incubators, right? The problem is that those companies by and large all come out soulless, right? Because like you talk to Bill in accounting, you figured out that he has some problem, you go use software to solve it, which by the way is now commoditized, right? So like that's not even that defensible. And then you wake up having raised money and realize you have a 10-20 year journey ahead of you to building something important, helping Bob in accounting, and you don't care, right? And like that's just brutal. Like I don't care how, like I'm a distance athlete, like I'm an endurance runner, like I know what that feels like. I'm all for athletes, but like you can't win at things you don't love. And so for me, I'd much rather back creators who natively love and natively have trust and believe in what they're doing. And for whatever weird quirk of history, they're super into like competing in chess tournaments in parks, versus like someone who kind of does a business school case and decides it's a good business, but doesn't have the soul.
100% agree. I love that quote. I just wrote it down. You can't win at things you don't love. I I was around during the first dot-com bubble, and I saw people building business, what everything you just described, right? Starting startups because they thought there was an opportunity and they never worked out. I'm seeing a bit of that with the AI boom now
A
too.
1000%.
Yeah,
It's too tempting, right? It's too
right.
tempting. Like, and I get it. It's just like, it's just not realistic in terms of really. I mean, like, the problem with anything in venture capital or anything in investing in general is like anything you say there's going to be an exception to, right? And since there's an exception, you can always point to the exception and say,
Mhm.
yes, but that. And you're like, you're not wrong. That
Yeah.
does happen. But, if you're an individual entrepreneur not owning the index, right? The fact that like it's generally or like almost always a bad idea and sometimes works out and people love to dream is doesn't mean that like you should do it, you know?
Yeah, yeah, totally. All right, a couple more and I'll let you get back to work. But speaking of AI, how are you guys playing this AI boom, if at all? What are your thoughts on that? Are you?
I mean, I'm so out on the era of companies that are called quote unquote AI companies and have been consistently, right? If you define yourself as an AI company, um, I have several problems. Like, one is you're too expensive for my business model.
Yeah,
There are
yeah.
too many people who are excited about the quote unquote AI branded company. For me, as someone who wants to make DPI, to like believe I can make money, because someone's going to be willing to pay 3 times as much or pay irrationally too much, which then makes it boring, right? So I'm like pretty out on that. I also think it attracts, to your point, like the narrative, a lot of posers in this certain way. I also think, for what it's worth, we're in this era where it's extremely hard to tell what's real and what's not real in pitches because they all kind of look the same. So I'm like broadly, as a seed investor, extremely out on AI stuff, right? Now, you can say I've been massively wrong on the trade so far, right? Like there's tons of stuff that is the AI stuff that if you're in it, you look really fucking smart. And if you haven't done it, you're like, well, you sat it out, right? And if you were a trader and could get out, which you can in some cases, there are liquid markets for some of this stuff. Good on you. Like that's good. I still don't believe it from like a first principles basis as good seed investing. All that said, I do think that if 2025, if you are not building with AI or using it, that's insane, right? It's like not using the cloud or not using the internet. It is like just because the narrative isn't, you don't want to invest in cloud infrastructure or whatever, or you think there's a bubble, doesn't mean that you shouldn't use the technology or this. Like, so in some ways, I'd say it's kind of technology. Hell yeah. Like I build stuff with it all the time. Like I think it's incredibly leveraged. It changes business building in cool ways. blah 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 blah. But like investing in AI companies, no, right? I do believe there are parts like in terms of things I do believe in. Like we've done a lot of bets in what I call like Voight Conf companies, which is if you know Blade Runner. In Blade Runner,
What? Say
this
that word again.
Voight Conf, it's from Blade Runner.
Okay.
It's the
Uh-huh.
test that they give that is destructive. It like kills you to basically figure out if you're a robot or a human,
Ah,
right?
okay.
And it's because the future's become so complicated. People can't tell what's real and what's not. They can't tell who's a robot and who's not a robot. That's basically the premise of the
We're
movie,
pretty much
right?
there now, but yeah, go on.
Well, that's my point is we
Yeah.
are pretty much there. We're close. And so if you think about it, the technology that's anti-AI technology, which says, okay, the world's gonna be full of deep fakes, people don't know what's real, people don't know who they're like if they're talking to North Koreans, like there's all sorts of like implications to that I think are really interesting and highly investable. But I'd say it's like that's the thing is like I'd much rather invest in the second order effects of AI than AI itself.
Yeah. Yeah. Well, here's one little data point. We had this event during Tech Week on Tuesday, and it had 400 some applicants. Every single company was an AI company or, had AI. And 300 out of the 400 all clearly built their websites using ChatGPT or something because they all looked exactly the same.
Right.
It
And
was
like
it was kind of crazy. Yeah.
yeah, I mean, I'm glad I didn't come to that event. It would not
Yeah,
have been
well,
worth
there was some cool stuff, but it was also
I'm
like,
sure. I'm
yeah.
being a jerk, obviously, but I'm just saying it's like it's there's this legibility problem, I think, in seed investing, which is that again, YC again, this like really didn't help. Although again, like I don't blame them for this. It's just reality. Is like if you're a seed investor, your basic job is to look at a ton of trash and crazy and bad stuff to find a few gems. If all of a sudden YC made all the rules and how to make a deck that looks good and answer the basic questions easy, then that is no longer a signal that there's any soul in it or whatever. It's just like, oh, everyone just know it becomes open source, right? If all of a sudden it used to be that like having a well-designed website and understanding these things was like actually a demonstration of real mental ability and perspective and understanding, that's how it used to be. If AI makes it if everything looked the same, then I'm fucked, right? Because all of a sudden, like I can't use any of the things I used to use to know what's real and what's not, right? And so in some ways, I think that's the interesting moment we're in. Is like, in some ways, like if you think about seed investors or early stage investors who are used to hitting bids, everything looks like something you can hit the bid on now, right?
Mm.
But it's not, right? It doesn't actually have what it's going to take to go the distance. It just looks like it does, right? And so we need to come up with new ways to separate that and understand it that are effectively a response to what's going on, where everything looks the same and it's all fine. It's not great, but it's fine, right?
Yeah, yeah. All right, last two questions. I'll combine them into one. Any particular types of startups you're looking for? Good business, of course, but anything you're looking for now, like any thematics, thesis, trends, whatever. And then flipping it around a little bit, what's sort of Slow Ventures pitch to awesome entrepreneurs? Go for it.
Look, I mean, I think you know this. We're generalists. That's kind of like the whole point of
Right.
this. So, like, I want great, great, great people on missions that matter. Like,
Mm.
just pitch me a business plan or a first business plan and make it good. Not because I care what the business plan is, because it's going to change 16 times, but I care because if you pitch me something incredibly stupid, that's an indictment of the thought process. Like, I care more about like that discussion than the actual business plan. But I really, if you're working on things that are unimportant, it's unlikely there'll be big successes. Like, why does this matter and big? And it like, what's the S1 story? Like, what is the big audacious vision? And then how good are you? And like, why are you so good? Are the questions I'm looking to answer. Look, I think shifting global slash internet power structures, like anarchist approaches and decentralized approaches to, big structural things like farming, things about truth and reality. There's a bunch of like thematics things that I'm interested in, but I'm very open. I just want to be told an amazing story by credible people who are on a mission to do it. What's our
What's the
pitch to?
last deal you've done or announced, if you can,
So I have a term sheet out now, and I'm about to do a really audacious deal that's almost signed. I mean, like we're actually quite active right now. I'm trying to think what's announced.
or
Look, I
even,
mean, stuff that's like widely announced, like Sublime Security is crushing it. Outtake is crushing it. Like, there's a bunch of companies that we've done recently that are absolutely doing fabulously. Area 2 Farms just got announced, which is
Mm.
kind of this decentralized anarchist farming platform that's awesome. Um, Merit First is a company helps start, and then Joe Lonsdale and I funded, which basically does merit-based hiring and recruiting.
Mm.
Like there's also, I mean, there's a lot going on right now, and I'm actually quite excited. But yeah,
Yeah,
it's all
cool.
across the boards.
And then
Um,
for when you find a interesting startup, what's the pitch to them why they should take your money? Then I'll let
um,
you go.
no, it's all good. I mean, the pitch is basically we're smart, we're connected, um, and we're honest. I think honesty is probably one of the most important things. Is like we're not gonna bullshit you. We'll like tell you what we think and how it is. And if you want those properties in a VC deeply, we have that. We're not going to annoy you. We'll always pick up when you call us or text us. We're very, very responsive, but we're not going to waste your time with standing meetings. We don't even want to be on your board, right? But we're here for you to win and be in your corner and founder aligned. And you can take us or leave us. Like we don't really like one thing. I do not like competing for deals. I don't really believe in it. Um, people talk about you have to win the deal. I'm like, look, you're either the right VC or not. If there's like 15 term sheets out and you're trying to top tick someone, you almost by definition are going to be overpaying, right? Like, and look, we'll miss an important thing every once in a while because of that. But I'm just like, I'd rather find places where the capital matters and it's scarce and we're doing something important and the founder wants to work with us. So like the pitch is pretty loose, but it is honest, right?
Yeah. And you feel, I mean, the vibe I get is you're fairly contrarian or more outlier focused than, right? I mean, am I wrong in that
You
assessment?
don't make money. I mean,
Yeah.
everyone in venture capitalists thinks they're contrarian.
Well, true, yeah. Yeah.
Like, I think what we do, I think we do different stuff. I think that in the metrics I would say that matter, because again, I do think metrics matter, is I don't think we really compete for deals very often. People either want to work with us or they don't. And I do think that we're very disciplined about pricing and what we invest, which almost by definition means that we're only working with founders that fit a certain box because we're not going to pay like a $60 million valuation for your AI thing because it just doesn't even fit how our economics work, right? And so like I think if you hold those things, you end up buying certain things and like some of those should work really well and we're okay when a bunch of them don't as long as it was an honest shot on goal.
Yeah. Okay, if this message resonates with founders listening to this, best way to reach you is it through the warm
I'm
intro
like Lessin,
portfolio company?
Lessin, my last name on everything. So just reach out however you want to reach out.
All
And
right.
if you don't like me, that's good too. Follow me and retweet bad things on Twitter. I think it's very important to both be loved and hated. I think people sometimes forget the second part. You can't if you are liked by everyone, there's no good, right? You need to be in a place where you have a tribe. And if you have a tribe, almost by definition, you have an anti-tribe.
That's interesting. Interesting perspective. All right, Sam, this is fun. Taking lots of interesting notes, lots of little good sound bites and nuggets, cool thoughts. Very cool. Well, thank you very much. Good luck with Creator Fun and Slow
Thank you.
VC in general, and we'll catch you after the next fund or something like that.
Something like
Yeah.
that. Enjoy startup week.
All
I'm
right.
kidding. I'm kidding.
Yeah, all
Bye.
right. Cheers. Bye.